Alright, what is going on, everybody? Welcome back to day 3. Day 3, yes sir, of the Beginner's Guide to Futures Trading series. Today we're going to be covering liquidity like I was saying in the previous video. Yeah, let's go ahead and get into it, honestly. So, day 3, liquidity. I guess the best thing to start off with is, what even is liquidity? Liquidity is what drives the market in the up direction or down direction. Liquidity is what causes the market to move. Without liquidity, the market is just going to be grinding sideways, basically, doing no big moves up or down. And what I mean by that, grinding sideways, is just consolidation. So, like, where it has no big activity whatsoever and it's just staying in the same spot, like this, for example. Here, the market, you don't really see the market do anything. I mean, for the course of many hours, we don't see the market breaking highs or lows, and it's just literally sitting in this little tiny range, just going up, down, and you don't really have any price action. Maybe here, big liquidity sweep, but which we'll get into today. But honestly, the market just isn't doing anything. That's what happens when there's no liquidity. Whenever you have liquidity, this is what happens. This right here is what happens. And basically, the technicalities of liquidity is resting buy and sell orders. That's literally it. Liquidity is literally just people's entries slash take profits and stop losses. So if you think about the majority of traders, first of all, the majority of traders are unskilled and they don't know what they're doing. They're just going to look at the chart and just go with the flow. And so because the average trader just kind of goes with the flow and doesn't really, their positions are just going to look something like this. Like, let's pretend that, I don't know, time stops here. Like, this is current. They're going to be like, oh, okay, well, we have, let's see, lows right here. Oh wow, highs right here. What are we doing? Well, it looks like we're on our move up. Oh, look, we're actually breaking highs right here. Oh, so what are they going to be doing? They see an uptrend. They're probably going to be wanting to enter longs. And so what are they going to do? They're going to set their stop losses all the way down here, and they're going to set their take profits probably way up here somewhere, typically above this high. And that is precisely what liquidity is. Like I said before, liquidity is just resting pending orders. They're going to have their pending take profits up here and their pending exits slash stop losses down here. And since it's an uptrend, the majority of them are going to go with the flow and probably long that. And so when price breaks this high right here, you're going to have two forms of liquidity. You're going to have people entering the position going long, like I just explained. So you're going to have people buying right whenever this breaks this high, because that's going to be their kind of confirmation to say, okay, it broke the high, price is going to keep going up, let me enter. And if you have anyone shorting, maybe they entered in right here looking to short the market, you're going to, and price starts to go up and break this high, you're going to have their stop losses, which are going to also typically be set above the high. And so the people shorting are going to have their stop losses set above this high, and that's also going to be another buy order, right? Because if you're shorting the market, you sell the contract and then you buy it back, and you typically want to buy it back for a cheaper price, and that nets you your profit. But obviously, if you buy it back for price worth more than what you sold it for, then you lose money. And so people shorting the market, they're going to have their stop losses set here. It's going to trigger a buy order, and then people entering the long position are going to have their entries set here, which is going to be another buy order. So once price breaks this high, you're going to have a lot of buy orders just automatically getting filled, and that's just going to propel price upward even more. And that is liquidity. This right here, pending buy orders and pending sell orders, because it goes the same way below lows as well, resting above highs and below lows. And when they get hit, it propels price towards that direction. But here's the thing, this is how price gets manipulated. So as I just now explained, right, above highs, below lows, you're going to have resting pending buy slash sell orders. If you're longing above highs, you're going to be looking to buy slash enter into the position, hoping it's going to keep going up. If you're shorting, then it goes above that high, you get stopped out, you have your stop loss set there, and you buy back the contract, or you buy back the lot. Below lows, if you're longing and it goes below low, you're going to hit your stop loss, you're going to have to sell. And then if you're shorting and it goes below the low, people are going to be entering the position, and so they're going to be selling as well. So you have two sets of buy orders above highs and two sets of sell orders below lows, each entering and exiting positions. Now, the market movers know this. The big institutions, the big banks trading all this, they hunt stop losses and entries. They know that liquidity, pending orders, lies above highs and below lows. And these guys have tons and tons of money and tons of orders that they need filled. They can't just, any average Joe can just place an order for half a lot, 100 lots, whatever it is. It's not like they're trading with millions, billions of dollars. Their orders can get filled easily at any point in the market. But let's say Deutsche Bank is looking to enter the market. They can't just casually dump a million, whatever the fuck amount of lots at any point in time, because they're not going to have someone selling a position if they're looking to long at, let's say, right here where there's like no price action going on. There's no volume at all. There's not going to be enough sell orders to fill their buy orders to enter their position, and vice versa. If they're looking to short, there's not enough buy orders to fill their sell orders. So what has to happen is they have to move price up to these points of high liquidity, up above highs and below lows, to move price to fill their orders for them, because there's going to be enough volume at that point. For example, above this high, what happens? We see price go up to the high, and at this point, a bunch of people, right? And you can literally see, bro, it freaking wicks. I'm going to skip this one because that's like not a good example, but you can definitely see right here. Price literally breaks the high. People are entering. You have a bunch of buy orders coming in. People are getting stopped out if they're shorting. People are entering if they're longing, hoping to hit the move up and keep going. And then so the price breaks the high. Big banks, big institutions finally have the volume of pending buy orders because they all got filled. Most likely, most traders have their stop losses or entries right here. So they all get filled. All the buy orders come in. And there's finally enough buy orders for them to hit their sell orders. Because let's say they wanted to short. What do they have to do? They have to move price up above highs to accumulate buy orders so that they can short, match the buy orders with their sell orders, and then because they all get filled at once, it starts to tank price. They pump price back up again just a little bit. Look at this wick. Look at that wick. And then what happens? Price absolutely gets obliterated to the downside. All their sell orders just got filled. Then what happens down here? Institution wants to go long. They want to move price upwards. So obviously if they want to go long, they have to match their buy orders with sell orders, right? Because it's a market. You're matching buyers with sellers. If there's not enough sell orders to fill your buy orders, you can't do that. So price breaks liquidity. All these pending sell orders start to get hit. People's entries, people's exits. Then finally there's enough sell orders throughout all this whole move down to fill their buy orders, and then they're able to move price up. And so the trick is with liquidity. First of all, you need to know liquidity is like a magnet. It pulls price. Price is attracted to liquidity, which is above highs and below lows. Price is always moving above highs and below lows because that's where liquidity lies. Now, the second thing you need to know, and especially whenever price is consolidating / moving sideways / literally doing this, doing nothing, just bouncing back and forth, doing absolutely nothing, is whenever it breaks those highs and it breaks those lows, it's not going to keep going in that same direction. It's only grabbing liquidity. It's called a liquidity sweep, a liquidity grab. It's just grabbing those orders so it can move price to the other direction. So if you see price accumulating, then you see it break a high, don't just be an idiot like 99% of the market and trying to long it if it breaks the high. Most likely price is going to want to go to the other direction. So if it's accumulating, you see price break a high, you're probably going to want to short. You're probably going to honestly set your stop loss where these guys are setting their take profits. If these guys are setting their take profits all the way up here or whatever, you're going to want to set your stop loss there, and you're going to want to short and go the opposite direction and hit your TP down here. Or zoom out on your chart, look at all these other lows that we see right here. We see a low right here, we see a low right here, we see a low right here, we see a crazy low right here. And so this is where you're going to want to set your TPs. You're going to want to set a TP, and obviously in increments. Your first one you're probably going to want to do right here, your second one you're probably going to want to do right here, and then your third and final one you could either do here or here. And that is what you want to be doing. You don't want to be the 99% of sheep that are just going to see this and then get filled up with pause, that's sus. Get a bunch of hopium and then start trying to go with the flow. And so whenever you're looking for liquidity, right, on the market, I'm in the hourly time frame. Literally just do what I just said, is you want to zoom out on the charts, or even better, actually don't even zoom out. Go to a higher time frame. I'm on the hourly. Let's go to the 4 hour. Let's see what's going on here. Now on the 4 hour, as you can see, if I zoom out, price currently is here. The closest point of liquidity, which is above highs and below lows, is going to be this high right here. This is the closest point of liquidity right here that price is going to want to go to. It's the closest high. Obviously, we have more liquidity down here. We have a low right here, and another low right here, and another low right here. And so there's actually a lot of draws on liquidity towards the downside, but the closest liquidity that we see is right here. And price is obviously drawn to liquidity. Like I said, liquidity is literally like a magnet. Just think of it like a magnet up here, drawing price, attracting it to go up this way. This point right here has the strongest magnetic force, and so price is going to want to go up here. And so what are we going to be saying whenever price goes up here? Are we going to be thinking it's going to keep going up?
No!
Once it takes out this high, we're going to immediately be looking for the next point of liquidity, the next closest point of liquidity. We're looking for a reversal. We're looking for price to start taking out these draws on liquidity down here now. Now, let's say, for example, price, instead of it being up here, let's just pretend price is like right here. Then in that case, the closest point of liquidity is going to be towards the downside, breaking below these lows down here. And obviously they stack up, right? So we have a low right here, and then we have another low right here that I can take out, and then we have another low right next to it right here that we can take out. Boom, boom, boom. 3 freaking magnets to make one big super magnet pulling liquidity this way. And so a lot of times what you'll see too is if you see liquidity stacked up like this, is you'll see price break one low, consolidate, 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 break another low, consolidate, 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 and finally break that last low, and then go below it, and then start making its way back up towards the next set of liquidity, which is going to be towards the upside somewhere. So the reason why we scaled it to the 4-hour time frame is because higher time frames have higher conviction. The lower the time frame, the more noise that you're going to see, the more kind of micro volatility, and you don't really know what's going on. And especially with liquidity, for example, I'm on the daily right now. We can mark out these highs on the daily and points of interest of where liquidity is going to be lying, and we can already see how close price is on the daily at these highs right here. And so we're going to assume that price is going to want to go up and take out these highs on the daily time frame. But if we scale down to the hourly, and you can see how much more choppier it looks, and maybe those points of liquidity, especially on even lower time frames like the 10-second, it obfuscates it so much, and it makes it really hard to kind of see what's really going on. Now don't get me wrong, you can go for liquidity on lower time frames, but it just has less conviction than the higher time frames do. Alright, so now that I've kind of explained these things to you guys, let me go ahead and show you guys some examples. So I'm gonna mark, you see this very choppy price action, right? Off rip, that's what you want to look for. You want to look for this choppy stuff. Then we see this, and instantly you want to start marking out your previous highs and your lows. I'm just gonna pretend that like none of that stuff exists, and you guys just pulled up from this liquidity sweep. And also, I'm not even sure if I define what a liquidity sweep is. A liquidity sweep is whenever you have big banks, institutions hunting people's stop losses / entries right whenever it breaks the high, price immediately goes into the opposite direction. That's liquidity sweep. It fakes them out, they think it's going to keep going up, and then it absolutely tanks in the opposite direction because they needed to fill their orders. And price sweeps to the downside or sweeps to the upside even. But the point is it goes the opposite direction that the majority of the market, which is idiots, thought it would go to. So these guys just got swept, so we can start to mark out these highs. Let's zoom out a little bit, and then we'll start to mark these lows as well. We have a low here, here, here as well. And so our big draws on liquidity are going to be above this high and below this low right here. So price just swept this low, already took out the major low. Now we're looking for it to start taking out the next point of liquidity. Price is here, and as you can see, our highs, we have more highs stacked up than we do with the lows, and price just already came back from sweeping that low. So more than likely we're looking for price to go up. We have liquidity here, we have more highs here, right? So where do we think price is going to go? Obviously it's going to want to go up and take out, most likely you're going to want to take out this high. Let's see where it goes. So it goes down, sweeps this liquidity initially. As you can see, that got swept. I'm pretty sure. Let's check the wicks. I can't even tell. Yeah, it got swept. It got swept by a little bit. It took out this point of liquidity. Now price is going to want to instantly start going towards the other points of liquidity. Okay. Boom. Swept this right here. You can see it. It literally, you can see it wick up, bro. You can see it like white candle, sweeps the liquidity. As soon as it does, it starts going down again. But obviously, we have more liquidity to take, so it's probably going to want to keep going up. Yep, we see it go up. We see it sweep this liquidity, go down again. And then you can see every time it sweeps liquidity, it like peaks. It makes a high, and then it starts going up a lot more. It shoots up, starts kind of consolidating around here because it's getting really close to breaking that high. And whenever you see that typically happen, there's a lot of fluctuation. Then eventually, boom, we can see it hit this high right here, breaking the high just by a little. It's not even that much, bro. Sometimes, yeah, you'll see it break it like a lot higher. But bro, sometimes this tiny ass little micro penis of a wick, that's all it needs. and then it starts making its move back down. It took out the liquidity. They got all their buy orders that they needed. Bro, these institutions are like the Nikado avocado of markets, bro. They just suck that stuff. Pause. Anyways, bro, it goes down, right? So we took out all these draws on liquidity. Boom, 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 boom. Got all the liquidity. Inhale. And now we start to move back down again. Most of these guys, these poor souls, probably thought it was going to keep going up. They see this candle. Boom. Wow, that's crazy. That's a crazy move up. Boom. Wow, that's a crazy move up. Oh my gosh. Wow. Look, it's breaking the highs. I'm going to enter. This is it. This is my big break. I finally got out of the rat race. Hell nah, bro. Hell nah. You got fucked. Okay, I'm going to show you guys one more example real quick, but I think it's a pretty easy concept to grasp. Okay, so what do we see right here? Let's pretend that we can't see into the future and market is right here. This is current price. What are we going to be looking for? Obviously, we're going to be looking for liquidity. We have a high right here, and you guys know what highs and lows are. A high is formed by move up, followed by move down. A low is formed by move down, followed by move up. We have our main high here, main low here. So obviously, I feel like you guys can kind of put the picture in your head as to what price is going to do. Price is here. We have a high right here. This high is a lot closer than these grabs on liquidity down here, but there are more grabs on the downside than there are on the upside. So most likely, what do you think price is going to want to do? It's going to want to come up here, take out this high, and then start making its way back down to take out all these grabs on liquidity down here. So let's continue. Let's see what price does. Boom. Instantly. Takes out the high. Takes out the high. People are entering. People are longing. Oh my gosh, I'm going to be a millionaire. You played yourself. Now, what do we see? What happens? What happens? Okay, kind of goes back up to the high again. Doesn't really do anything. Boom, ping pongs a little bit. So now we kind of see a little bit more consolidation, like through here, I guess. If you wanna call this like a little consolidation range, whatever. Who cares? Boom. Instantly, one giant candle down. Right. These guys, whenever they were taking out these highs, they were filling their sell orders. Every time it took out a high, we see it take out the high. Boom, sell orders filled. Takes out the high. They needed some more sell orders. Boom, okay, whatever. Boom, okay, whatever. Finally, on the last grab, all their sell orders are filled. They're able to push all that. Bro, they broke this point of liquidity. They broke this point of liquidity. And they wicked all the way down here. And actually, it came really, really close. But you understand the concept. They went for all these points on liquidity right here. And you can see it actually eventually ends up coming back without breaking any of these highs, by the way. Yes, it comes back up, but it ends up coming back and taking out that point of liquidity before starting to move up all the way up here. And yes, I'm on the hourly. This is over a course of days. It still works the same on any time frame you go. You can see this stuff happening. If I go to the 5 minute, you can literally see the same exact thing happening. Liquidity, 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 liquidity. Prices here. What are we going to want to do? Make our move to the downside, take out these draws because it's closer. Oh my gosh. Oh my god, bro. I didn't even see that. That's crazy. Okay, bro, I honestly thought it would win a ping pong, but that's a crazy dip. Boom. Takes out those lows. Okay, let's kind of go like to right here. What do we see? Liquidity here, liquidity here, liquidity here, here. Right, bro, I could do this all day. Okay, prices here. What are we going to want to do? There's no more liquidity to draw on the downside. We already took them all out. We're establishing newer lows, right? There's nothing else here to pull. So obviously we only have liquidity on the upside now. And so there's only one way to go, and that's up. So it goes down a little bit, goes up, and bro. Order filled, order filled, order filled, order filled, order filled. Keeps going, keeps going, keeps going, all the way to the present. And this is on the 5 minute. You can do this by yourself on the 5 minute. So am I saying that every single time you mark out liquidity and you try to predict where price is going to go, it's going to go there? No, it's a market. Markets aren't absolute. There's randomness involved. Obviously, you cannot, bro, if you could perfectly predict the market every single time, you're either the Rothschilds or a crazy Jew or both. So use liquidity as a tool. Don't use it as your one and only holy grail, Hail Mary indicator to take trades off of. You want to mix it with other confluences. Later, I'm going to start teaching you guys about fair value gaps, order blocks, equilibrium, bunch of other stuff. There's so many more things that you can use to take high probability trades off of, and you're going to be able to stack them up together, stack up these concepts together. Then you can see an order block plus a fair value gap, mark out your liquidity, and if all those confluences are telling you bullish, then most likely it's going to want to go in that direction. So then you're going to be able to take higher probability trades and make a lot more money. So with that being said, I hope this video helped you guys identify liquidity. I hope that it served a good purpose, and I will see you guys next week for our next video, which I'm not too sure. I think we're going to do a chart setup video. We're going to teach you guys how to set up your charts to look like mine and show you guys how to make it a lot cleaner, so that way, you don't have a bunch of stuff in your face, and you can kind of be a lot more organized. So we're going to take a break, I think, off of just one video from technicalities and move on to just cosmetic. But yeah, stay tuned and don't get liquidated like 99% of traders. So